What's up? So today we're gonna get out of here. What are you doing? Go. So, what's it like not having a plan? It's like planning to fail. Yeah, that's not gonna happen on our watch. I'm Mark Monroe, and this is your Come Up. So today we talk all about trading plans. And what are they? They're one, personal, and then two, they're a decision-making tool to helping you make a better decision when it comes to trading. Now, one thing I wanna make sure is, this is not about strategies. This is all about plans, and plans come before strategy. So, there's 7 things that you need to know in having a trading plan. Let's get started. A lot of you are asking, why do I need a trading plan? The reason why you need a trading plan is it helps you find your enter and exit strategies. 2, it helps you become more disciplined. And 3, it helps you stay on par as it pertains to reaching whatever your long-term goals are. So many of you are asking me, Mark, why do I need a trading plan? Like, what is the whole benefit of me using it? There are 3 reasons why. Reason number 1, trading is easier. You're prepared. Number 2, you make decisions. No emotion, just boom, decision, done. And then 3, discipline. You find out what works and what doesn't work very quickly. How does this work? Here are the 7. 1, it's motivation. 2, what is the time commitment? 3, what are your goals? And they're definitely different than motivation. 4, risk-reward ratio. 5, assess your knowledge. 6, how much capital are you going to be putting in? And 7, document the process. Step 1, the first thing is motivation, right? Why are you doing this? Like, what's the whole purpose of why are we here? If you're not motivated, then you won't get behind what you're doing. And so it really answers the question of why is it that you're trading? And then 2, what is it that you hope to achieve with this? The second thing is time commitment. Now, to be a solid investor / trader, we typically say that you got to dedicate time to this thing in learning, studying, and also repeat 1 and 2. So goals, when it comes to defining your goals, it's just a few simple things that we measure it. We call it the SMART metric. Is it specific? Is it measurable? Is it attainable? Is it relevant? And is it time bound? It's just that simple. And if they don't measure up, there's nothing to talk about. So for example, if you're getting started and you need to have an idea of what the SMART metric looks like to be applied, here you go. Try this on for size. I would like for my investment to be a year long, and by the end of that year long position, I like to be up 40%. And then at the same token, I also want to have, say for example, a 5% buffer for me to potentially sell. And then I need to be getting out of this year long position within, let's say, 9 to 10 months, leaving 2 months in time. That right there is what we call SMART applying to your goal. So the very next thing that we look at is risk-reward ratio. Now, when we look at risk-reward ratio, it's very simple. How much are you willing to risk, or how much risk can you stomach to get to, say, for example, the reward, right? And then we put it in some fancy ratio. So let's give you an example. I'm willing to risk $1,000 to get to my reward and profit of $4,000. So my risk-reward ratio is 1 to 4. Now, most traders normally look to a 1 to 3 ratio for every single trade that they hop into. If it's less than 1 to 3, which is the very bare minimum, then most likely this is not going to be the best of an investment for you. So when we look at risk, well, you have to ask yourself, as any investor or trader, how much risk are you willing to take on? You can take on a lot of risk, and a lot of folks like to go high risk and high reward. Or you can take on a lower risk and then take on decent reward, or say for example low reward, depending on where you start. The overall objective is don't lose money. Keep in mind, all investments carry some form of risk, whether high or low. You just have to ask yourself, is it one, worth it? And then two, can your pocketbook handle it? Speaking of pocketbook, the very next section is how much capital? All right, so you want to invest money. Let's just do something interactive. We're going to do this a little bit of like YouTube magic. You ready? So you want to be an investor, or you want to get into the investment game. So how much money or how much capital are you willing to invest? Okay, now that you have that number in your mind, or you just said it out loud, how much of it are you willing to lose? Now, if your number is a little bit different than what the first answer is, go with the second one. Never go with the first one, especially if the second number is different. Now, why is that? Because never invest money that you're not willing to lose. I mean, if all investments are risk, like we just talked about in risk-reward ratio, and if you're only willing to lose this, then why would you invest more? A simple rule of thumb is always make sure that you can afford the max potential loss in any trade. It's just that simple. If you can't afford it, then don't invest it. So now that we've understand our risk and we understand capital, our very next section is called assessing your knowledge, aka the knowledge tree. So how much time have you actually dedicated in learning about this investment? Like, the worst investments that we talk about are, say, for example, investing in a Starbucks company. And you're saying, I'm going to invest in Starbucks because there's every Starbucks on every corner. That doesn't make it a good investment. And here's the reason why. Say, for example, you invest, and this is all hypothetical. Say, for example, that you invest in a Starbucks, but because of the fact that there's a Starbucks on every corner. But what if they're losing money on every other Starbucks location that they have on every other corner? Is that really as profitable as you thought it was going to be? And the only way that you would know that is studying the fundamentals. If you study the fundamentals, and if you also let your eye test tell you, and if you're also looking at other factors that are out there, then you're going to be able to easily assess that knowledge. But you got to dedicate the time to actually doing the research. So if you're only looking at something for, let's say, 10 seconds and saying, okay, this is a good investment, most likely you're gambling. And we do not advise for you to do that, though that we're not financial advisors, of course, but this is just simple common sense. So how do you assess your knowledge, right? Well, key things. The market will always change, aka variable change, and so too must you be willing to adjust. And as the variables change, so too does it add another ingredient towards your knowledge that you must study up on. One of the things that we always say when looking at investments, we always say not only look at the company, but also look at the sector or industry. The reason why you want to look at the sector or industry is because it will tell you if, say, for example, the sector itself is struggling. So, for example, if we're looking at tech, and if tech is, say, for example, taking a beating, which means that everything in tech is just down, and you're going into an investment, you have to ask yourself, why am I going to invest in this company? One. And then two, what makes this company stand out from the rest of the sector? Typically, when you're looking at a sector will kind of tell you exactly where most of the investments in it are going. So then there are three things in which that you need to look at for assessing your knowledge also: volatility, potential losses and gains, and timing. Now, when we look at those three items, here's another stat to keep in mind that you do not want to be a part of: the 98%. And that means 98% of retail investors and traders, so pretty much you and I, will essentially lose 100% of their entire investment. So let's just do a quick deep dive on that one. Volatility. Volatility just tells you whether or not how predictable or unpredictable the market is or the position is. So how do we read that? High volatility means more unpredictable. Low volatility means more predictable. Potential losses and gains. Before you look at any investment, so if you're an option trader and if you're doing an investment, your potential loss is the entire investment. If you're a stock investor, you have to look at it like this: how much of a percentage am I willing to say I'm willing to take on as a loss before it's time for me to get out? And the same rules apply for when you're on the upside in the gains. I've reached a certain point and this is the moment or this is the time for me to get out. And there's nothing wrong with that. The other part is timing. And timing really does hit for options traders or stock traders, but mostly option traders. Because many times you'll find that retail traders are always trying to trade on the short term, aka day trade. The problem is that many times you can't time the market always. And sometimes there's other things that may impede that progress, whether socioeconomic, political, various different things that can throw off your investment. So that's why we say timing is everything. And that's why we always like to focus on the long term. So since you're getting started, let's focus on the long term. Long-term investments also typically win out over short-term investments. And now we reach the final stage that literally sums it all up for us. Keep a diary. I mean, you want to document your progress just to show the lineage of how you became a better investor. And there's no better way than to do a diary. Have a trading journal, if diary is just too strong of a word for you. So what do you document? You document your trades, and then also, what are you learning? So then 6 months later, you come back after you've done all this documentation, and then you can see the growth in yourself as an investor or trader. Now, with all these things, you've now developed a solid plan and you're ready to go out there and kick ass. Congratulations. Now that you have a plan, the very next thing that you need to sit down and think about is, what's going to be your strategy? But with this trading plan, you're now able to go out there and tackle the rest of the market. Well, good luck. If you like what you saw in this video, go ahead and give it a thumbs up. If you didn't like it, and if you think that we can do better, it's okay to give us a thumbs down. Just let us know why. And if you want to continuously keep watching the come up, go ahead and hit the subscribe button. And if you want to be in the know, go ahead and hit that bell to be a part of the notification squad, aka the Cool Kids Club. Well, until next time, I'm Mark Monroe, and this was your come up. Peace.